Hello everyone, welcome to our case presentation on Norfolk Southern Corporation Century Bonds. My name is Catherine and together with my group, Meredith, Mark, Chris, and Zoe, we have analyzed the case box and devised a solution. We believe that it would be helpful for the title insurance company. First, we will introduce information and background of the company. We will also state the two problems we are going to solve. And then we will talk about the background of the problems through SWOT analysis, economic facts, competitor analysis, and bond issue information. Then we will give out the solutions and some concerns as well as recommendations. Now let's take a look at the company information and background. On the New York Stock Exchange, Norfolk Southern Corporation is named as NAC. The company was formed through consolidation of Norfolk, Western, and Southern Railways. NAC is one of the nation's premier transportation companies. Its subsidiary, Norfolk Southern Railway Company, operates approximately 19,300 road miles in 22 states and the District of Columbia. It serves every major container port in the eastern United States and provides efficient connections to other rail carriers. NAC is a major transporter of industrial products, including agricultural, forest and consumer products, chemicals, and construction materials. It is also a principal carrier of coal, automobiles, and automotive parts since its railroad operates the most extensive intermodal network in the eastern United States. On the next slide, I will talk about the problems we are going to solve. In this case, we analyze the following two problems. The first question is that how much higher a yield might be anticipated on the new 100-year bond, and the second question is that is the 100-year bond a right choice, or should we choose a bond that is matured in 20 years? Now let's move on to the next slide, the SWOT analysis. As mentioned in the previous slide, Norfolk Southern Corporation operates over 19,000 route miles in 22 eastern states of America. It is a leader in East America's transportation infrastructure. There is also improvement in its productive and operating metrics. However, its debt burden is increasing and it has a relatively low global presence comparing to the other three leaders in its industry. The opportunities for the company would be the increase in the traffic volume and the demand of coal in the United States. Meanwhile, there is a significant governmental legislation and regulation over commercial, operating, and environmental matters, which is the threat to the company. The rise in the cost of raw materials would be another threat to the company. Next, let Meredith talk about economic facts.
Thank you, Catherine. I'm going to talk about the economic facts. The first part is financial crisis. Shortly before 2010, the financial crisis of 2007 to 2008 caused huge losses to the U.S. economy. U.S. GDP declined by 0.3% in 2008 and 2.8% in 2009. But the economy is slowly recovering in 2010 with a 3.2% growth in the late 2010. The problem we are studying is taking place in such a period. On August 24, 2010, the crisis of financial and economic turmoil has gradually subsided and the global economy has recovered. The second part is the trend between corporate issuers. Interest rates in United States, which have been falling since 1997, were 3.56% in September 2010 after the financial crisis. Interest rates in the United States have gradually stabilized on the way down. A large number of corporate issuers, sensing a change in economic conditions, want to raise long-term funds at low cost in the face of rebounding economy and the Fed's tendency to raise interest rates. This is the main reason for the increase in the total value of Norfolk Southern Century bonds. Next, Chris will introduce the Century bonds.
And now I would like to introduce the new issue Century bond by NSC. So first, the new issued Century bond has a value of $250 million and it has a coupon rate of 6%, which is paid semi-annually. And notice that the new issued 250 million bond was added to the existing 300 million debt, which also has a coupon rate of 6% and which was sold in 2005. And notice that normally people will not buy the long-term bond with like 100 years to maturity. However, we have like the target buyers, which are insurance companies and pension funds, because these type of companies, they have a strong demand of buying the long-term bonds to match their long-term liabilities. And for this new issued central bond by NSE, this bond received Baa1 from Moody's rating, which is the eighth highest rating in Moody's long-term obligation rating. And this rating is considered as a moderate credit risk. And this bond also received a similar rating from other financial institutions with a rating of BBB+. And both ratings indicate that these long-term, like the central bonds, are considered as a investing level. So now I would like to introduce next team member to introduce more about the background information.
Now let's take a look at the companies in the railroad transportation industry. As of 2009, NSE was one of the big four in the railroad transportation, along with the Union Pacific, CSX, and BNSF. During 2009, NSE had the most, 8 billion in the railway operating revenue, 29% of which came from the transporting coal and iron. For the first 6 months of 2010, revenues and net income had grown almost 23% and 53% respectively, compared with the first half of 2009. For Union Pacific, its annual revenue in 2009 is about 14 billion, which is the largest railway company in America, and its revenue increased about 20% in 2010 compared to the last year, and interest income increased by 47% in the same year. Similarly, CSX and BNSF have an increased revenue about 17% and 9.8% respectively. It's clearly to see that most companies are recovered from the financial crisis after 2009 with an increasing revenue. However, a good DE ratio should be between 1 to 1.5. Most DE ratio is in a high level. CSX have the highest DE ratio among the 4 companies, which was exist too. That means CSX have been aggressive in financing its growth with debt. In other words, a high DE ratio is often associated with high risk. It's not a good time for investors to invest money in the bond market. At that time, investors will more focus on the future interest. So next, I will let Mark to introduce investor information.
Well, for the investor information, first, investor must consider their yield and for long-term investment. This picture shows the yield about government bond. It provides investor with a certain degree of stability and yield. But we can see from this line graph that government bond has been in a slow downward trend in recent years. So in this case, the main investor mentioned in the case is titled insurance company. And for other investors, a lot of investors has strong demand for century bond, especially life insurance companies and pension fund mentioned in the case, since those companies need to match their long duration liabilities with a long-term income stream. And then we move on to next part.
Now we will anticipate the yield of a century bond in 2 aspects. Firstly, based on the information we have on the market price, coupon rate, and the time remaining to maturity, we can use the financial calculator to calculate the yield to maturity from the high-grade companies that issued century bonds. The last column shows the difference for the yield change in recent 10 years. Most bond has a yield change around 0.5% to 2%. The rates of these bonds had been declining due to the world financial crisis during 2008 to 2009, When expectations of future inflation rise, long-term yield rates would rise to compensate for the loss of purchasing power associated with future cash flows from bonds or loans. When there is no economic crisis, longer maturity bonds usually have a higher yield to maturity than short-term bonds. The change of the yield will around 0.82% under the influence of a flattened curve. We summed up the yields to maturity from 7 companies and calculate the average of the yields change shown on the left column. The result of the 0.82% is referenced from the yield change for a couple of century bonds in other companies, as mentioned above. Secondly, we will consider the yield based on the features of a flattened yield curve. The government bond is usually the benchmark used to decide mortgage rates across the nation. In this case, we will use the 30-year U.S. government bonds as a reference. So how much higher a yield to anticipate on the 100-year bond? The historical yields on the 30-year U.S. government bonds have a slightly decreasing trend, but the yield is around 4 to 5% in most years, except when some unexpected economic situation happens. Thus, this can be seen as a flattened yield curve. Based on the features of the flattened yield curve, if the yield curve is flat, it implies there is little difference between short-term and long-term rates for the bonds of the same credit quality. Now the U.S. interest rates fell and began to stabilize. Combining our price calculations, we expect the yield of 100-year bond will flatten between 0.5% and 2%, which the yield to maturity is around 4% to 5.5%. Next, we will move to mark for the solution that we need to choose 100-year bonds or 30-year bonds.
So the second problem for this case, we need to make a choice between 100 years bond and a 20 years bond. So for title insurance company, which bond is the right choice? Well, for this question, I want to answer it in 2 directions. In the first direction, we can judge by yield and price. We can see that the data on the right is short-term bond and century bond issued by some well-known companies. From the previous question, Zoe has calculated the yield to maturity of this bond. When we observe this bond to maturity, we can find that the yield to maturity of most century bond is higher than the yield to maturity of short-term bond. Additionally, we look at the market price of this bond as 2010. We can easily see that the market price of most century bonds is lower than the market price of short-term bonds. Therefore, with the 2 factors, I think 100 years bond is a good choice for title. So for the second directions, we can know that in this case, the company which want to build a portfolio is a life insurance company. For a life insurance company, they generally have long-term debit, and bonds are a typical fixed income investment. Asset liability matching requirements are rigid, especially in terms of maturity and yield matching requirements. This creates clear constraint and restriction on investment objective and the investment strategy. The selection of bond asset must be largely consistent with the majority of the liability to ensure sufficient cash flow for repayment. Bond yields are largely covered over the insurance period, which may span multiple economic cycles. The interest rate in the life insurance policy can avoid the spread loss, and its serious impact on company. Therefore, from the perspective of the company needs, the 100 years bond are also more suitable for title insurance company. And next is the concern part.
Thanks, Mark. Now I will talk about the concerns. 100-year bonds are often subject to early redemptions, often associated with countries with unstable economies. We also notice that 100-year bonds have a longer duration than short-term bonds. Bond prices fall when interest rates rise. They are the most sensitive to changes in interest rates. As a small company, when the economy wobbles, its exposure to 100-year bonds is more severe for the company as a whole. Also, Title is a small insurance company, and most policies have to be paid off on average over 15 to 20 years. Given the cash crunch and the early redemption of the bonds, there is no guarantee that the economics of Tidal at that moment will be favorable. Tidal needed to make a careful assessment of its future and financial position before they decided to buy the 100-year bond. After considering the concerns, Chris will give us some recommendations.
Hi, this is Li Chen, and now I would like to provide the final recommendation for investing in a central bond. First, frequently examine the company's financial circumstances by going through the annual report, including balance sheet, cash flow statements, and income statements to understand how the insurance company operates and whether the company has a healthy financial status. Since having a healthy financial status, such that as a small insurance companies, we are good to hold the central bond. And second, always keep an eye on the market interest rate, since we know that as the interest rate increase, the bond price decrease. So this is as we know, it is the interest rate risk. Thus, if we expect the interest rate will increase, then we may consider short position, meaning that we sell the bond at the current price and buy it back after the bond price decreases. And lastly, since we are investing in NSC central bond, it is always crucial to follow up NSC's performance to get the idea of how the NSC operates and what the future trend of NSC. Suppose if NSC are not performing well, then the credit risk is expected to increase, and we may consider to sell the bond. So as a final recommendation, we should always remember, first we have the credit risk, and also second we have the interest rate risk. And thank you so much. This is what we have for this case analysis. Thank you so much. Have a nice day.